And I got a 0 down, no payment, no interest loan for 2 years.
What's up, guys? Today we have special guest John Keifer, better known as Johnnyloans.
Hey.
Welcome to the show, bro.
Thanks, man. Thanks for having me.
Dude, so like we were talking a little bit before this, and you actually started your own bank, which I mean, like
That's
it's
right.
well, I'd love to dive into this. And so you're a loan officer. You've done $500 million in loans over the last like 10 years, but you actually started your own bank. Like, can you break that down for us?
Yeah, sure. So it's not the kind of bank where you deposit money into it, but it's still technically a bank. So it's called a correspondent line.
Okay.
So I'm a mortgage broker.
Okay.
So
okay.
we have dozens of banks that we can broker loans through, right, for mortgages. So what we did is we started a correspondent line, a bank line.
Okay.
So it's kind of like a revolving line of credit.
Okay. And how big is this line of credit?
The most recent one we have is about 10 million. I think we have about 50 million right now.
50 million total. Wow. Okay.
3 different lines.
So I think like for the viewers, the way that a bank works, like when I was young, I thought all a bank does was just hold your money, right? Like they just like but like they obviously like do a lot more than that, because when you look at like banks in the world, they always have like the nicest buildings. They make the most money, I feel like, out of any kind of like business. And so like, how do they actually make money? It's actually from originating loans, right?
Yeah. So for those banks where you deposit money into, they're trading that money left and right? They're investing in different things. But for us, it's mortgages only. So what we do is we get a loan.
Okay.
And then we get them, we use an underwriter that is accepted by the bank line.
Okay. So you have like the $50 million in like the bank line. Right. You use that money to give a loan to somebody.
Yes.
Okay.
So when you close a loan on a mortgage, the bank or the lender will fund that loan and send the money to escrow.
Yeah.
Well, we're doing that now.
Okay.
So that's our money.
That's crazy. Okay. Yeah. I love it.
High risk.
Is it?
It's high risk.
Well, what's the risk? Like what could happen?
The risk is maybe the investor's not going to buy it. Maybe we made a mistake.
Okay.
And they're like, you know what? That $500K,
you guys got to eat it. I see.
And we would have to figure out how to do the servicing.
Oh, okay.
Which isn't what
so
we
if
do.
So like the way it works is like you take out you have $50 million. Let's say I want to buy a house for like I want $1 million loan.
Sure.
So then, hey, like Johnny, can I have like $1 million to buy this house?
Yeah.
You say, let's go, Dad, and you give me the $1 million. Then what's the next steps for that?
On the bank line side?
Yeah.
On the bank line side, so we give you the $1 million through escrow, the escrow company, right? And they disperse it. And then the company that we broker through on the correspondent line will purchase that loan.
They'll buy it back from you.
Buy it back.
Okay. Or buy it from you.
Yeah. So it's kind of like a credit card. We had $1 million on there, and now we sold it for $1 million. So now our bank line is back to 50 million again.
What means so you're not? But you sell it for like a 1.1 million, right? So you're gonna make some profit when you sell it.
So here's the thing: the profit's not very big.
Okay.
Not in this kind of. There's a profit there, but it's just enough to maintain everything, because all this stuff has a cost, right? Someone has to manage the book, someone has to manage the line, move the money around between the different lines, all those things. So there is a, what do you call it, a VIG on there.
But typically, so like the way that like a normal bank works, like let's say like a Bank of Hawaii or Central Pacific Bank is, they'll use what's like a Fannie and Freddie rules, right? So like that's a government-sponsored entity that they make the rules of how like the loans need to be like underwritten.
Yep.
So then like they'll give out they have like, let's say like Bank of Hawaii has like $100 million, right? Yeah. So like they give out $1 million loan. As long as it follows that Fannie and Freddie rules, then after they get the loan, they'll sell it to Fannie Freddie or like another entity that will purchase these loans.
That's exactly right. And so that's how they make money, right? They package up these loans and they sell them. In fact, if any investors want to look it up, it's MBS it's traded as it's securitized.
Mortgage-backed securities,
Mortgage-backed securities, yes. So you can follow that.
Okay, and then that's actually how like the whole crash in 2008 happened, right? So do you want to explain how that works?
Sure. That was before I was in the business.
Okay.
So everyone knows, right? In fact, I bought a house during that crash.
Okay.
I took advantage of
the great rates and like no verification things.
And the price of the homes.
I wish I was like investing at that point in time. I feel like it would have done really well. So.
Yeah. If we only knew, right?
Yeah.
So the lesson learned there is that, well, back then it was like the wild, wild west. Lenders were doing anything they wanted. I heard stories from colleagues saying that like they'd get like someone was like, oh, I'm a yoga instructor and I want to buy this $1 million home. Okay, how much do you make? And they would just say, I make, I don't know, $50K.
Yeah.
They say, oh, you sure you don't make 75K? Oh, I do make 75K. Okay, here's a loan.
Oh, yeah, that's crazy.
So in the thought pattern back then was, okay, get that loan on a variable rate, like it's going to adjust.
Okay.
And then we'll just refinance before.
I see. In the future down the line, yeah.
And then it never got better.
The rates,
all these people who had all these homes they couldn't afford.
Yeah.
Rates adjusted, and now they're upside down.
Yeah, and then they went into foreclosure, and then and then the third party companies or Fannie Freddie, whoever it is that's buying all these MBS or mortgage backed securities. Now they got all these loans that are underwater or in foreclosure, so they're losing a lot of money, and then that's a snowball effect to kind of crash the whole system.
Right. And so the home I bought, the person was somebody I actually knew, and she was underwater on her home, which means it was going to be a short sale. And so
a short sale is, can you explain that, what a short sale is?
A short sale is like they owe more than the home is worth.
Okay. So let's say the home is worth $400,000, but they actually own $500,000 in a mortgage. Okay.
Right. And so now the bank has to take a loss. So they have to negotiate how much of a loss they're going to take. Right.
So that's what a short sale is,
that's
right?
That's what a short sale is, right? And back then, 2006, 7, 8, 9, when this crash happened, there were so many short sales. So that when I went to buy the short sale, it took us almost 11 months to close.
Oh, wow. So she ended up getting the house?
Ended up getting the house.
What is the house worth today, you think? Did it go up a lot of value?
I don't own it anymore.
Oh, okay.
But I made $100K off of it.
Okay, I mean, that's a good, so you buy it and you sold it like later down the line?
I sold it later, yeah.
Nice.
Yeah.
I feel like just like in general, real estate is such a great way to build wealth or to get big chunks of cash as long as you do things conservatively or do it right, And so you're in the industry, you see like all the time, you see people buying houses, selling houses, and then you're part of like the biggest piece, I think, in a lot of like the people's eyes is the financing of these assets.
Right, and a lot of people don't understand just how important it is when you're going to buy a home. So like logically thinking, you would say, okay, I'm going to go talk with the real estate agent. I'm going to go look at some homes. But the real hack here to get ahead is go to the mortgage loan officer first. Get pre-approved. Because I can't tell you how many times it's happened where somebody went shopping for homes with the real estate agent. It's a little bit different now because they have to have the buyer's rep agreement.
Okay.
But they'll go and look at a home and then they come and see me and there's no way they're qualifying for that price home. So now they're heartbroken.
I see. So like they're like, hey, like they went shopping for, let's say like a new house for me and my family. We went on to look at a bunch of homes, and it's like a long process, right? There's lots of like your things that like don't work out. I don't like this one. I like this. So I found like my dream home. I'm ready to buy this. Now when I'm ready to like make the purchase, I come to someone like yourself and like, hey, Johnny, I need $1 million for like this house. Can you help me out? And then they can't qualify for it, and then now like, okay, now they just wasted their time for nothing.
Yeah, and now no one's happy. They're not happy. The real estate agent's not happy. The family's not happy. The seller who opened up their home for them is not happy.
Wasted their time.
Everybody's time is wasted. So the best option, the best thing to do is go get financing first. See your loan officer, whoever that is. Just go see them.
Okay. There's like a lot of different options they have for to get financing. What makes like separates like one loan officer from another? Like, why would I choose like, let's say you over Joe Schmo from Rocket Mortgage or whoever it is?
Sure. Joe Schmo from Rocket Mortgage. All right. So there's a big difference between loan officers.
Okay.
There's a huge difference. There's experience. There's personality. There's availability and access to different mortgage products. And like we were talking about, I'm a mortgage broker and also a banker because we have a bank line.
Yeah.
So I literally have access to dozens of banks. So I can always find the best product for whatever the situation is, even if it's a non-conforming type of, portfolio loan. So that has a lot to do with it. And also with me and my team, you're going to get one-to-one communication and experience. It's not going to be, you're not just a number. Like we're going to communicate, we're going to call, whatever the best mode of communication is that the client likes, we're going to do that. Is it calling? Is it texting? Is it emailing?
So let's say like we're shopping for like our loan officer, what's kind of process should someone kind of like go through to kind of vet? Like, cause like same with real estate agents, you usually interview like a few, but I feel like with loan officers, from what I've seen, it's just like, pick up the phone, boom. The first one I call is the one I'm going to use. Like, should they even shop for it, or what's the way to find like the best? Because even like, let's say like if I'm going with a bank too, like it's usually I'm not going to check multiple banks. I'm just like, I bank here, I'm going to get my loan from here. Like, like there's no kind of like no thought process in like the loan.
Yeah. Well, there's different ways of going about it. Absolutely. So there are some people that say, I bank at this bank. They already have all my info. I'm just going to run with it. The only problem with that is that you have to make sure that that bank is offering you what you need as far as loan products. So if it's a standard conventional loan, the rates aren't going to vary too much between lenders.
Between banks.
They're just not. So now it's a matter of who do I, well, as they say today, vibe with? Like, do I like this person? Do I like this? Do I like how they talk to me? Do I like the service I'm getting? And a lot of times, big banks won't be able to offer that kind of customer service. Some can.
Yeah.
But when you go to a mortgage broker shop that's got 20, 30 loan officers like my company, then you're going to get that one-to-one experience.
Because you guys specialize in basically in like the loan process. Like that's like what you think about all day as far as like your bread and butter.
Yes. And we're always looking for new ways to make it better, make the process better, because we all like speed and we all like ease.
Yeah.
Right?
Yeah.
So for our VA loans, we've really streamlined the process because just like other people, veterans don't have time, especially if they're active duty. They're busy.
Yeah. I mean, that's the big thing too. I think is like there's a appreciated amount for like just saving time and having a good experience. You know, like if we don't have to worry about like going back and forth and like having to like fill a lot of paperwork or do different things, like that's actually why we buy a lot of houses, because we provide a great customer experience for the person. Right. So we'll buy for a little less, but then like the customer experience is such an important part of like any kind of business.
Yeah, it really is. And that's something you have to think about. And there are certain personality types. They don't care about any of that stuff, Daniel. They just like, I just want the lowest rate. I don't care about the personality. I don't care anything else.
Yeah.
And for those people, maybe they're not the best fit for me, and my team.
But I mean, if they could be, because you have the access to so many different products, you can shop around the loan to see like where can I actually get the best rate or the best terms. And sometimes it's not just the best rate, but it's the best terms, right? Like there's a big difference between the two.
There's a big difference. So when I said that person might not be the best fit for me and my team, it's just because they're going to continue to look for the lowest rate, which we can do to a certain point if it's realistic. But unfortunately, you'll get call centers. You call this number and mainland bank, and then they're going to quote you something ridiculous. Whether or not it works or not, they're going to say yes.
To kind of get you in the door, start the process. And then and this has happened to us before where we got quoted a very good rate and terms. And then like on the last hour, like maybe like a couple of days before closing, we get the term sheet. I'm like, hey, there's all these extra fees, all these extra like rate hikes. And like, we weren't told about this. And then we've come so far, like it's been like months before we could actually close. We're not going to like just change in the last minute. Like, okay, we're just going to bite the bullet and just pay these costs, like, you know, which is kind of dirty, but I mean, like it does happen. So, yeah. It
does happen. It's rare these days. And I'm sorry that happened to you. Hopefully it wasn't any, well-known company.
I won't know any names, so.
But our business is so regulated on the state level, on the federal level, that those kind of things shouldn't be happening. Like we have to disclose from the beginning,
I see,
middle and end. So that shouldn't be happening. It happens, but it shouldn't be happening.
So I mean, like going back to like the bank, like the whole idea of the bank, like how do you guys like determine whether or not you guys are willing to loan out your money for like a loan or not?
There are some people in our company that aren't as experienced in the banking line like I am. Because we had a banking line during the COVID times.
Okay.
When the rates were in the twos.
Yeah.
And we couldn't keep up. It was just so much
like
purchase loans, refinance loans. We literally could not keep up, which is a great problem to have.
Yeah, as a business, right? Yeah.
And then we realized that having a bank line in those times and not being prepared for the rush was way too risky. It was a headache. I mean, it was like, because we had to balance. We had so many loans going that we had to take out an extra line of credit.
Okay.
Like we already had
to keep up with like the keep it up. The volume.
So let's say we had a $50 million line and we had $55 million in closings this week.
I see.
We're $5 million short.
Yeah.
Can we have $5 million more? Okay.
Yeah. So who's giving you all these lines of credit?
Yeah. So there's Plains Commerce Bank. They do it for us. We also bank with them on the corporate level, so that helps. There's other ways of going about it. It's
Can a normal person get access to these lines, or how does that work? You know?
No, it's highly regulated.
Okay.
You have to have a certain amount of bonding and insurance. I forgot the numbers, but it's up there. And you have to have X number of years experience because they understand It's a high risk.
Yeah, because I mean, like having access to this amount of cash can be like, maybe I'm gonna buy a Lamborghini or something, right? Or like buy a new house or something. So
I'll make up the money later. No. It has to be all legit. And can I talk about the difference though?
Yeah, please.
Because we don't have to use the bank line. We can do the regular broker.
Okay, and that's how most loan originators will. They just use a regular. They go directly to the lender as opposed to like taking out their own money first, right? So what's the benefit for you guys to like use your own money versus like the lender?
So for us, we have more control. So we have more say in how this loan can go. Whereas if it's full 100% broker, we have to follow whatever lender we're using to broker's rules to a T. Like we have to follow everything they say.
And there's also like probably communication wise is you guys can make the decisions as opposed to having to wait for the decision from like somebody else.
To a certain extent, we still have to use an underwriter who's trained on the Fannie and Freddie guidelines. And we're going to follow those to a T.
Okay.
Although we have access to being able to price it correctly in a competitive market from interest rates, we also have to be cognizant of the fact that we have to follow Fannie rules to a T, even if we were brokering. It's the same thing.
I see.
It's just riskier.
I see. I mean, that does make sense. So I mean, like just kind of like being in the industry with like loans and money and equity, like what's like the best way to use, let's say, an asset or loans or money to like build wealth, like personally, you know?
Yeah. Can I share a story that
I did it? Sure.
Okay, great. So if you don't mind, I'm going to talk about you a little bit too.
Yeah, I mean, as long as it's a good story.
It's a good story. I'm a success story, and I'm a testament to you and your team. So let me tell you. I don't know if I told you the story before, but I bought a home in 2021.
Okay.
Brand new home.
2021. That was like a good time to buy, right? 2021.
Yeah. It was right before everything switched.
Okay. So this is when more like the interest rates were really low.
Yeah.
Still.
They were starting to tick up. I got in just in time.
Okay.
By the way, you can never time the market. It's actually luck.
Yeah.
I'm not a believer in luck, but in this is actually luck. You can't time it. So I got this house and I decided to put solar panels, right? So it was like $56,000
for solar.
Okay. And I was like, you know what? I'll just get a loan for it. So I went to a credit union and I got a 0 down, no payment, no interest loan for 2 years.
Wow, that's really good.
It's great.
Really good, yeah.
And I was like, oh, cool.
Yeah.
I got these panels.
Yeah.
My electric bill is $31, I think, a month now.
Oh, nice.
Right?
What was it before?
It was in the hundreds.
Okay.
Yeah.
So you're saving like hundreds every month then. So,
hundreds. Yeah. And we're not even air conditioner type of people. Like we don't have everything blasting. So it would be even higher.
Yeah.
I mean, I am. My wife's not. So that means I'm not.
Yeah. No, I mean, I know how that goes. Yeah, right? So happy wife, happy life.
Exactly. So I'm no payment. And then my thought process was I'll just, when we get close to the 2-year mark, I'll just refinance it and just kick that can down the road.
Yeah. I mean, I think that's like a lot of times most people are like, hey, that's how credit cards work, where it's like, hey, like, I do the same thing. Is like, if I can just have it now and then worry about how am I going to pay for it later, like that's like, and it's like a natural thought process for like a lot of people. Just get the bag and figure it out later, right? So yeah,
absolutely. And extend it out and just never have to make that payment until at some point you will. But I'm going to leverage that money somewhere else. Yeah. So fast forward about a year, almost 2 years, and I'm like, oh man, this thing's coming due. I got the letter in the mail. Oh, let me call. I call them up. I say, hey, I'm gonna like renew this. Can we just start over? And they said no.
Yeah.
And I said, okay, what are my options? She said, you have 2 options. 1, you can just pay it off. Okay. Or 2, you can start making the payments.
Okay.
I was like, dang, that's it? How much is the payment? And she's like, hold on. And she clicks it. I could hear it clicking. She goes, it's $982.
Wow. For a monthly payment for like solar? Wow.
I'm like, for $56K?
Yeah. That seems like high. Well, maybe it's like a short-term loan. That's why. Yeah. So
it turns out, it turns out it's the length of the loan.
Yeah.
I was like, oh. And it's 2 years shorter now.
Yeah. I see. Right? Yeah.
So I was like, I don't want to pick that. I don't want to make that payment. So, I have some money on my HELOC that I've been like looking for an investment. I'll just pay it.
Okay.
So I took $56K, paid it off.
From your HELOC?
From my HELOC.
Okay.
Attached to my home.
Yeah.
And the payment dropped significantly. I was like, oh, this is great.
Because the HELOC interest is like a lot less than what you were paying for.
Like it was great because I got that HELOC when I got the house.
Yeah, so it was a good interest rate.
It was a good interest rate. And so I was like, you know what? I don't want to make this payment either. I know it's only a few hundred, but I just don't want to make it. What can I do? So I was talking with Josh on your team.
Okay.
And he was like, hey, if you ever want to invest with us, we'll give you the. I was like, okay. So I just called him up and said, hey, is that still going? He goes, yeah, man, let's go. So long story short, I took another $50K out.
Okay. From your HELOC?
From the HELOC.
Okay.
and invested with you guys.
Okay.
And now the monthly payment that I get from you guys every month on the first pays the HELOC.
You're kind of like the typical story of why we do what we do is because we enjoy investing, right? We buy houses, we rent everything, we sell them, we do some other things. But then like we need capital in order to do what we do. And then in return, we take investors like yourself who would like invest with us. And then we pay you out monthly in interest. But I feel like it's win-win because like your capital allows us to do the deals that we do, but also we wanted you to live your best lives by having that monthly truly passive income to kind of like pay for your solar panels or pay for groceries or rent or car payments or whatever it is for your daily life, so.
Yeah, that's great. And I know that you're a humble man and you don't want to, brag about yourself. So thank you for what you do for me and my family. Appreciate it.
Thank you for like the story and the acknowledgement. But I mean, honestly, it's like, I think even the Bible they talk about is it's more like blessed to give than to receive. Like I honestly enjoy, so when you're looking at like your company as a whole, like the highlights of your company is like when you make money is like you receive, and like these are like very good. It's a good feeling to make money, right? Like like you're paying for your bills, whatever. Yeah. But then some of the best better feelings is when you actually can give money. And I think we're like in the rare position. So some companies, they give money, let's say like to charities or to like their churches or different things. But then our company, we're able to basically to give to our clients money every month, which like, that's like a fun thing for us to do. Like, so I think I genuinely enjoy like being able to say, hey, like here, John, here's like your interest rate for this month. It's something that's we really enjoy as a company. So
that's great. And I get an email ahead of time from your team every month. Yeah. Oh, tomorrow we're depositing your money. Like, oh, that's right. I forget. I'm like, oh, that's right. Because I already have everything paid off, right? So this is just money that goes right to pay off the HELOC.
Well, I got to give you $20 after the show. I appreciate you for like that, for just like sharing like our company. And you actually like knew Josh from like back in the day or something, right? Yeah. So Josh is one of our team members who he's like a big part of our team. And then you guys actually like that's the kind of testament to Hawaii. Hawaii's like such a small world where like everybody kind of knows each other. Like it's like we all know at least like one or two the kinds of way, right? Is where we know each other. And so you actually like knew Josh before.
I did. So it turns out during the COVID times, we were actually next door neighbors.
Oh, really?
We're next door neighbors. And so Josh's mom is a real estate agent.
Okay.
So we would talk about real estate stuff sometimes, and then. Josh, he was working hard. He's a hardworking guy.
He is.
He wasn't working for you yet.
Okay.
But you already know how hard he was working, right? So I would rarely see him, but we were cool, right? Hey, John, we talk a little bit. He loves basketball. I love basketball and football. We would just talk sports mostly. And then when it came time for him to buy his condo, I helped him with the financing.
Okay.
Right? And then I ran into him one day after he started working with you.
Yeah.
And what are you up to these days? And we caught up and he told me about it. And then I started coming to your events.
Yeah.
And we just kind of started working together.
Oh, that's so. Yeah. There's such a good like close relationship between like agents and mortgage brokers, right? Like the money and the houses, they go together.
They do.
And so like as a loan originator, like what are you looking for in like a real estate agent to work with?
Right. I'm looking for someone who's gonna trust that I know what I'm doing and my team know what we're doing, and and we're gonna have the same trust going back to that way, right? So they have to know that we're a team, and I'm gonna help them build their business outside of the escrow that we're in. If they want my help, I'm gonna help them.
Are there certain like teams that you guys work with like regularly, or you guys have like a lot of synergy with?
We do have some teams that we work with regularly.
What kind of value do you think like you bring to like the equation for like with the real estate agents?
That's great. So in the real estate world, most people, a high percentage of people are insufficient in the follow-up.
What do you mean by that?
Like they just don't follow up properly. They just don't. I had a call from somebody the other day.
Yeah.
They said, hey, listen, I got 3 referrals from my realtor. You were the third one on the list. You're the only one that answered the phone. I was like, really? Yeah.
It's so crazy too. And I think like a lot of times, like a lot of these different professions, like being a real estate agent, being a loan officer, being like even a contractor, these things, it's very easy to get started because like there's a low barrier to entry. Right. But then like, because it's very easy to get started, there's a lot of people who are like, they're not putting any effort into it, and they get started and like they won't call the person back. And like there's been so many times where like, hey, like I have my credit card, I want to buy this thing, like I'm ready to go. but then they just won't call me back. Like it's like the simplest things, and you can like really differentiate yourself by honestly by just being average, because there's so much like sub-average kind of like competitors in the marketplace.
Yeah, I think it was Gary Vee who said it's easy to outdo your competition.
Yeah,
and I thought about that. And I guess so, because for loan officers, I don't know if this is true, but it's close. That we're now down to 93,000. Across the country, where we were at like 180,000.
Oh wow! So almost less than half then.
Yeah, they didn't renew the licenses.
It's just because like the volume of like loans are down.
It's
less.
Down.
Yeah. I also I read like or someone told me like this statistic. I'm not sure if it's true or not, but they're saying there's that like when you look at the real estate industry as a whole, like one of the indicators of like health is the volume of transactions. Right. So like it's like, so there's like the amount of money of transactions, but there's also the volume of transactions. Right. And I think in the last year and a half, it's actually been less than like the 2008 crisis time. So if you're looking at like the pure volume for like various reasons, even though prices are staying high because like the equity and different things, the actual volume of transactions is actually less than in 2008. So for loan officers and real estate agents in particular, is actually an escrow companies is actually a tougher time, because you're paid more on the transaction volume than just like the home price alone, right?
Right. There's not enough inventory. So we have to remind people not to believe the headlines. They're saying inventory is up, home prices are up. Home prices are up. That's just because there's not enough inventory.
Yeah. So that's the tricky thing, is like it seems like very healthy, because the prices are still the same. There's no huge drops, but there's no like nobody is selling their houses at the same time. Less people are buying, but less people are also selling. Yeah. So then like there's just less transactions for all like the players to kind of be involved in.
Have you heard of the locked-in effect?
No, I haven't.
So the locked-in effect is people who bought those homes in the 2s and the 3% rate.
Okay.
Or now they're in the 6s.
Yeah.
They're locked in. They're so in love with their rate that they're not going to sell or refinance, nothing.
I'm a child of that. Like, so this house over here is like a 2.9 or something.
Nice.
Like I can never sell. Like it's like it'd be so hard to sell it. Like, just because like I can never like regain that mortgage. And so
in your case, it's okay because you're using it. You're not going to outgrow it. I'm talking about these guys that they bought like a condo, good sized condo at like 2.5%.
Yeah.
But they've got 2 kids now and a dog. Yeah. But they're so in love with that 2.5 rate that they won't.
No, I mean like honestly, like I wanted to sell this and go somewhere else, or like do something else with the equity. Yeah. But like it's like I can never sell it. Like no, literally.
You're one of those guys. Huh?
Yeah, I am one of those locked in people. Yeah. Like definitely. So
you're locked in.
But it's such an interesting. It's like a good problem to have, because like you have like this asset, but because you have the asset, like it's kind of like it stops you from making the more moves. So sometimes it's kind of like this balance of like, do I want to bite the bullet here and like give up something that's really good to chase something that could potentially be great, but it's not guaranteed? Like, I feel like that same thing happens in business, in life, like a lot of different things, where we want to stay in the safe, like secure zone, and we don't want to venture into like the unknown, because even though there's a potential for you bigger, it could also be worse. So.
Should we tell them to start packing up? Because it sounds like you're changing your mind. You might.
No, I mean like we're locked in over here.
You're locked in. Okay,
I mean I'm stuck in, like, so I like that. Gotcha. And every situation is different, right? You're the pros and cons, different things, but it's just, what are you gonna do with like your equity, with like your job, all these, there's so many different like assets and resources that you have. And then it's really interesting because as a loan officer, you have privy to like all they're basically their whole life, right? Like their income, their assets and things, because you need it in order to underwrite them.
We need it.
But then like a lot of times I bet you can see where there's like a lot of inefficiency in people's lives, where like maybe they spend too much, they budget wrong, then more than they make, and so that's really bad for their DTI. Or let's say like they have like all this equity that they're not using, that they could like redeploy somewhere else, get a HELOC, maybe like do some like investing or things or whatever it is, or maybe like, but then like you have like access to like all these different like scenarios, and like over the course of like your career, are there some common themes or threads that you kind of see?
Yeah, there are a lot. A lot of times student loan debt is a thing, of course. That's
what do you mean by it's a thing? Like,
what's that?
What do you mean by it's a thing? Like it's a lot of people have student loan debt.
A lot of people have student loan debt and credit card debt. Credit card debt is probably a bigger problem than student loan debt. In fact, it is a bigger problem, and it's because we're putting everything on our cards now. And it's so much easier to just
it's so card, right? You don't even think about what the balance is, right?
You don't feel it.
It's a magic little like thing that just makes things go away, or you can buy stuff.
So I've been putting in an effort to pay with cash more, but there are places that don't take cash.
Yeah.
I pull out a 20 for like a $10 bento, and they're like, "Oh, we only take credit card." Oh,
yeah.
All right. So credit card debt is a big thing. I've one thing that really shocks people is when I look at their income. Let's say it's a married couple, and I'll look at their income, I'll do all the calculations, then I say, "Listen, together between the two of you, you make $15,000 a month," and they're like, "We make how much?"
Yeah.
They're like, "Oh, we don't have any savings." And I tell them, "Well, you're putting this much into your 401k. You're paying this much in taxes. This is going to your medical.
Yeah.
But your gross is 15K." And they are floored. They can't believe they make that much money.
They see how much like the top line is.
Yeah. And so then I just tell them, "Listen, and you're renting. So if you want to offset some of that, we need to get you into a home, like a starter home, anything. We just need to get you start building equity."
Why is like buying a house versus renting like better?
Well, for some people it's not. So I don't want to make people who are renting and are
like a blank statement.
I don't want to make them feel bad because we all rented at one point, right?
Yeah. I started as a renter. Yeah,
Me too.
For a long time. Actually, bought my first house 3 years ago. Actually, only so like very.
Really?
I mean, this was my first house actually. So.
This one?
Well, I mean, like my first primary. So,
okay. But you flipped some homes.
In the meantime before.
Yeah. So the biggest part of home ownership, the best part. There's a couple of great things about it, but what I like most about it is the equity that you gain.
Okay.
Even if you have a small down payment, like we can do a 3% down payment on a conventional loan. Right, it's possible. You can do a 0 down VA and 0 down USDA.
So like, I mean, can we actually like bunny trail on that? So like, there's a 0% USDA loan. So like a normal person in Hawaii, they can put $0 down. They're not in the military or anything, right? And it's called a USDA loan.
USDA.
Can you like explain that a little bit more about that product?
It's from the Department of Agriculture.
Okay.
Right, and so it can't be in an urban area.
Okay.
And the only urban areas on Oahu are, it's from like Hawaii Kai to like Mililani.
Okay.
And there's even a sliver right there, I forgot what it's called, of Mililani that's
still will qualify for
by that Safeway over there.
Okay.
By that Jack in the Box over there.
Okay. So I mean, like as long as you're not in that zone, you can qualify for a USDA loan.
0 down.
Okay.
There's mortgage insurance, of course.
Okay. And what is mortgage insurance? Sorry.
Mortgage insurance is an extra payment you make every month to. It's like insurance you're paying to the lender to say.
Okay. So it's like an extra fee on top of your mortgage, basically. Okay.
And the purpose behind that is it's a loss mitigation technique or tool for the lender. Right.
Got it.
And so Fannie Mae and they all require it if it's under 20% down.
Okay. So even if you're doing 3% down, you still have to pay mortgage insurance.
You do. Now, just to be clear, there's an option where you don't have mortgage insurance and you have 3% down, 5% down. It just results in a much higher rate.
I see. Right?
So let's just stick with you're going to have mortgage insurance.
Okay.
Even though there is an option, we'll put an asterisk next
for simplicity's sake.
Sure. So USDA loan has to be outside the city, 0 down, but the debt to income ratios are much more strict. They're lower.
Okay.
So we look at the debt, monthly debt, monthly income.
Okay.
And we find out what that percentage is.
Okay.
And so for USDA loan, it's going to be around 40. Can't be much higher, maybe even less than 40. I think it's 38, 36, somewhere in there.
Okay.
Yeah.
So when you're saying the debt to income ratio, for people who are not familiar with that term, the debt to income ratio means like how much like you make gross, right? You pull in every month, and then or it's divided by or is the opposite way around. It's like how much did the house going to cost monthly divided by how much you make every month gross, and that's your debt to income ratio, which has to be in this case like 36 or 37%.
Right. There's actually 2 debt to income ratios. There's a front end and a back end.
Okay.
So the front end, one of them is just your monthly debts without the new mortgage, and the second one is with the mortgage. So let's say someone makes $12,000 a month.
Okay.
$12,000 a month. We can use half of that for a conventional loan.
Okay.
So $6,000 a month.
Okay.
All of the recurring monthly payments and the new mortgage payment, taxes, insurance
has to be under 6,000. Got it. And that's how you qualify for a loan.
That's how you qualify.
And then if you are over that, then you basically don't qualify for the loan. Right. Are there any hacks in order to qualify for even? Let's say like I'm above that line. Let's say like my mortgage, everything together is like 7,000, but I only make 12,000. Is there a way to kind of like hack that to get it like to qualify?
There are ways to do that because that back end with the mortgage payment is what's putting them over the limit.
Okay.
If we could get a lower rate.
Okay.
Maybe because that's going to lower the payment.
Okay.
If we could get the seller to contribute to help us buy down the rate.
Okay.
That helps sometimes too. We've done that to save loans.
So you can actually, so this is very interesting because there's a lot of times when I think like, this is where like a great loan officer comes in, I feel, is where, and this has happened to us, where like one guy's like, there's no way you can do it because like you're over the limit. And then like, I was okay. Like, let's just ask him a couple other opinions. And the one guy's like, I can get it done. And here's how I'm going to get it done creatively. And I know like this is one where like you were saying, hey, you can have the seller of the house actually buy down the rate for them. Now they can qualify for the mortgage, right? That's one way. There's other ways where like, hey, like, let's say you have like a car payment or something, like just pay it off completely, whatever, take a loan for your mom, whatever, pay off your car payment. Now that brings your DTI like lower. So then now you can qualify, or pay down your credit cards or different things where like, as long as your monthly like on the hook is less, that's how you can qualify for large amounts. And then you can kind of figure it out like later.
So. Yeah. We've had cases where we tell somebody, listen, if you can just get your credit card down to under, and we'll tell them the exact amount.
Yeah.
If you can make it $75 a month, which means you need to put $2,000 into that.
Yeah.
You're going to be okay.
Yeah.
Or you can take an extra $2,000 and put it into your down payment, have a bigger down payment. The opposite is also true. We say, okay, look, you've got $30,000 that you want to put for a down payment. When you're over the limit.
Yeah.
But if you pay this off for $10,000 and have a $20,000 payment down
payment,
you'll qualify.
Yeah.
You'll have mortgage insurance. It's okay. You qualify.
But I mean, it's just you're moving the things around. It's kind of like a puzzle, right? Like there's like a math equation along with the puzzle where like if you know all the pieces and how they work together and like the relationship between them, now you can kind of play with it to make it work for the person. And what turned out to be like there's no way to do it. Now there's a way, and like it maybe or may not be the best solution. Like, but then like at least they have the options to like, hey, I want to move forward with this because of this or not. You know. So.
Right. I tell people all the time it's like a Rubik's cube. You got to figure all that out. Okay, got it. And don't get me wrong, there are some times when we couldn't get it done, but another lender could, and it's usually because they have some kind of special incentive going on, right?
Like a promotion or something.
Yeah, like a promotion.
I see.
Like, oh, we have this special 0 down conventional. Like, okay, well, I guess.
I've heard of like these different things where it's like bank statement loans or things where like you don't even have to show like your income paycheck, but you have like just like money in the bank that qualifies for you as like to qualify for loan, or just like different kind of like creative products, you know. And so
bank statement loans are great. I close about one a month of those. It's usually people who own a business and it's a cash flowing business, like a hair salon.
Okay.
Or some kind of sandwich shop or something like that, where they just get a lot of cash and hopefully they deposit it.
Yeah.
Right.
Regularly, right?
Yeah.
So.
And then we just look at the deposits. We total them up over 12 months or 24 months, whichever best fits them. Okay. And then we use that as their income.
I mean, just to play like kind of like a devil's advocate, or just ask a question is, can somebody game this? Like, let's say like I want to in the future just qualify for like a bank statement loan. Can I just create like if I were to like, I guess we would be fraudulent, but then like just let's say like create a bank account and just deposit like 20 grand to that every month from like my other checking, and then I just wondering like would that what's like the rules and that kind of thing? You know what I'm saying?
I like how you think.
Okay.
But it wouldn't work because they want to see that it's a legitimate business.
Okay.
They go to the DCCA, make sure it's
standing. Okay.
Gotta have it for at least 2 years.
Okay. So I mean, there is some due diligence, and somebody can't just go around and just I'm just gonna make like 20 grand to the bank account for 2 years, and then now I can qualify for like a bigger house or something. So okay.
Yeah, because then you could just go to a bank and get like a personal line of credit.
Yeah.
And just make an account.
Well, that's what I'm just like, I mean, because like the thing is like it's interesting because as an investor or like a business owner, we're always like trying to problem solve it creatively, and there's a line that you can't cross. Like we don't want to break any like rules, right? Like we want to go to jail or anything. Right. But then you're always trying to see like how can you like creatively solve this problem of like where someone's never thought of it before. And a lot of times there's like a little loophole or something that someone hasn't thought of before. And like if you can be the first to kind of like I guess like figure it out, now you have a competitive advantage for the next like 2 years or something. Well, nobody else has discovered it, you know.
Yeah. Well, there is one creative thing that it's not for business owners though, unless they're a veteran. So for VA loans, we did this recently. Our veteran had too much debt. And so what we did was we got seller credit.
Okay.
And we used that seller credit to pay off his debt at closing.
So so like on the closing table, you're actually using that's like really interesting. So like let's can we put some numbers to this, like so we can like solidify. So like let's say he's trying to buy a house for how much?
I think it was about $875K.
So he's trying to buy a house for $875,000, and then he has like credit card debt that does not let him qualify for the loan.
There's a little bit over.
Okay, so what's like let's say what 20 grand, 30 grand credit card debt, or what?
About
12 grand credit card debt, but he has no cash to pay it off, right?
He didn't have enough.
Okay,
but he didn't have enough. So what we did was the real estate agent negotiated a seller credit.
Okay,
right, and we were going to buy down the rate just as part of the negotiation. And it turned out that as part of the negotiation, we were going to do a 2-1 buy down, right? Okay. So it was going to be a lower rate for.
Can you explain that a little bit?
Sure.
2-1 down.
So a 2-1 buy down is the seller contributes funds to the buyer.
Okay.
And with those funds, we pay the first year of the mortgage.
Okay.
2 percentage points lower than it normally would be. So if it's going to be 6% normally, it'll be 4% for the
first 2 years. For the first 1 year. Okay.
And then the second year, it'll go down 1%.
Okay. So and then it goes back down to like, or it goes up 1%, and then it goes back up to 1 more percent to 6. So like when you're qualifying for the loan, are you qualifying off the 4% or off the 6%?
You're qualifying off the 6%.
Okay, so you're still qualifying off the 6%. Right. So why like what's the so it doesn't help you qualify for the loan? Like it's just like to make the buyer's life easier.
Yeah, to make it easier.
Okay.
To make the lower payment. And
it's kind of like interest-free loans for like 2 years, like where you just like I'm gonna just pay less for the first 2 years and then kind of figure it out later, kind of thing. Okay.
Because the thinking is that in the next couple of years rates are going to go down,
or I'll make more income, or I'll find the cash some other way or something. Okay.
And so we'll just refinance into the lower rate, and we're already paying that lower rate. So it's kind of an incentive.
Okay.
It's an incentive for the seller to give to the buyer.
Got it.
So in this case, we had those funds, and he didn't have, and his credit card was higher than initially.
Okay. He spent some money that he shouldn't have.
And normally, it's kind of a long story, but normally we wouldn't have to see his credit again.
Okay.
But he opened up a new credit card.
Okay.
Against everyone's advice, right? Okay. And so now I got to look at everything again.
Okay.
It's like, oh, he got this new credit card, and now he's got.
So I mean, just for like I guess to like what not to do.
Yeah.
So when you're in the middle of the loan, and like there's like let's say you're going through the process, like you went through underwriting, like you qualified for it. What are things you should not do as a home buyer?
Yes. Don't open any new credit.
So don't open new credit cards. Don't buy a new car.
No.
Don't
buy furniture for your new home yet.
Don't buy furniture.
Yeah.
Okay, so even furniture.
Well, you can buy it as long as you're not.
As long as it's not on credit.
Yeah. Okay. It's a little bit of a fine line. They can do it on credit as long as, because what happens is we check the credit up front.
Okay.
And so we see all their liabilities, and then after 2 or 3 months, that credit report will expire, and we'll have to run it again.
Okay.
So if we're going to close in that time.
Okay. And so if there's any new liabilities, that could be an impact like that.
So here's the thing. When you submit a loan to the lender, even if we're using the bank line, they're going to put a monitor on that person's credit.
Okay.
So when anybody checks that credit, they're going to get an alert. And they tell us, hey,
someone checked that credit.
Yeah, someone just dinged their credit on a hard inquiry.
So even if you check that credit during that time, the lender is getting an actual alert. I didn't even know this. Yeah. And so the scenario would be like, let's say I want to like take out a loan from you for $1 million, right? Like here's all my information, Johnny. You're like, oh, it looks good. Here's your credit report. Once I submit it to you, your team or your company puts a monitor on my credit. If I apply for something or make a hard inquiry, now you guys get a notification and say, hey, what are you doing to what are you trying to do? And so
we do. So it's whichever investor we're sending that loan to, they're going to put it on it because they're protecting their investment, right?
Got it.
And then they tell us, and then we have to go to you and say, hey, what happened? Say, oh, you know what? This actually happened. Somebody bought a new Tesla. I'm like, that's a $1,200 payment. What happened? And you know what he told me? This was back when you had to order them.
Yeah.
And he goes, yeah, they told me it wouldn't be ready for like 9 months, and it came at the 3-month mark.
So then did that loan end up closing, or was that
okay? Yeah. He had a little wiggle room. So okay.
But so this guy, he doesn't have, so he's like over the limit. He doesn't qualify because he opened up a new credit card basically.
Right.
So then like, you guys are okay, like now we can't close this loan.
Right. So what we did was this was just last year, I remember. So what we did was we still did the buy down.
Okay.
But there was leftover from the buy down.
Okay.
Like it was like a $15K buy down, but we only needed 12.
Okay.
So we said, hey, we got this extra $3K and you need to pay off debt. So we're just going to apply it to your debt.
Okay.
And he's like, you can do that? I'm like, yeah.
I didn't know you could do that too at closing. So
here's what you got to do is you have to just, you get the statement for whatever the amount is from him. Like I think it was Citibank.
Okay.
So you got the Citibank statement and then we gave it to escrow. We said, we're going to pay this off at closing.
So escrow is going to pay down like the credit card directly.
Yeah.
And then with that pay down, now you actually qualifies for the loan. And so you kind of save the day by just like moving money from here to there, and just like being creative with this thing.
Yes. And there was times, this is only for VA. There's been times when there was excess credit, like we were talking about. The guys they qualified, they're good to go, but they're like, I was like, listen, man, you got $2,000 here. That's just going to go away. We already prepaid the taxes as much as we can. We prepaid the HOA as much as we can. We still have $2K. I don't want you to lose it. Do you have any debt? Besides,
so you can just
talked about.
Have escrow just pay down your debt for you. Wow, that's really. Yeah. They can't just get the cash though.
They can't get the cash. That's the thing.
Oh, that's really interesting. So so this is really interesting. So like the way it works, like say you have the 0% down, VA, USD, whatever it is. Let's say the seller gives you let's say a $20,000 credit, right?
Right.
Then like if you have let's say technically if all your costs are covered or whatever, then like your closing costs, you should be getting 20 grand in cash at the end of when you're buying the house because the seller gave you the credit, but you can't actually receive cash.
Right.
But then if you have a credit card with 20 grand in it, the seller can pay off your credit card or your escrow can pay off your credit card, and you can technically kind of receive the cash indirectly by paying out a debt or a liability.
Yeah.
That's really interesting.
You made me think of that when you said loophole, because I'm like, well, it's a loophole, but it's not. It's in the code, so you can do it.
Yeah. I mean, it's within the rules. That's the thing. It's rules, so loopholes are always it's within the rules. Is you're playing by the rules. Like if a lawyer or whatever to look at is hey, you can actually do this, but it's just a creative way to solve a problem that somebody has not thought of before. Right. And so I think the government probably was not thinking someone would utilize it like this, but it's a perfectly viable thing where so technically right, looking at this loophole is I could buy a house, ask for a $20,000 seller credit. They won't give it to me in cash, but I could rack up credit card. I mean, I could open a credit card, do a cash out 20 grand from my credit card, and then have escrow paid on my credit card 20 grand. Theoretically,
you could, but it has to be a VA loan.
Okay. So this is only for VA loans.
VA,
okay.
It has to be VA. Otherwise, we'd all be doing that, right?
I mean, it's just really, really interesting.
Yeah. So it's not a gray area. It's it's just something that a lot of lenders don't remember. We can pay off debt with a VA loan. So we've used it twice in the last year. One was to save a loan, and one was to make sure that the guy didn't waste $2,000.
Yeah, so he got the full benefit of it. So
he was like, "You can do that?" I'm like, yeah. He's like, "Sweet."
That's so awesome, man. Yeah. I mean, I love the creativity, and I feel like a lot of times in our space, whether it's a real estate agent, investor, or loan officer, there's always a lot of creativity, but especially in the loan origination world, I think that's where a lot of creativity can come into play. And that's what what a great loan officer will be able to figure out, whether it's actually different products, whether it's trying to solve the problem within the product. But I've seen a lot of creativity with loan officers to kind of make some of these things happen,
Yeah, we have to get creative. Sometimes I'll ask the whole company, all 30 of us, say, hey, in fact, I did it yesterday. Say, hey, do we have any place for this? And they're like, yeah, try this. Oh, okay, thank you. Because it's actually a physician's loan. And they've kind of.
That's a separate product just for physicians, right? Yeah. They get either a better rate or
medical field. So it could be a nurse. They get, because they usually come out of medical school or nursing school with a lot of debt, right? Racked up, right? So it kind of forgives that a little bit. Doesn't really take it into play.
I see.
The thing about that is the banks that do those loans are usually depository banks. And so, where you cash your checks and stuff.
Okay.
Deposit money. And so what they want is this young physician's
business.
Okay, we're going to help you with this loan. We want you to get your car loan here. We want your
I see.
here,
Like it's like a long-term relationship kind of thing.
Yeah.
That makes
smart,
sense.
right?
Yeah.
It's a smart way to go about it.
How do you guys like market like your company, your business for like for the loans? Like how does somebody find out about you? Like, you know, how like you get like, is it referrals? Is it like you do marketing? Like what's the kind of like the way that you guys make money?
It's a combination of things. So basically for me, I do a lot of marketing on social media.
Okay.
Mostly Instagram, starting to get back into Facebook a little bit.
No YouTube channel?
I don't have a YouTube channel, but Justice is giving me a hard time about it too. You know, Kamoha and Tristan, right?
Yeah.
You know, they're telling me, you should do this, you should do this. And I still haven't done it. Mm-hmm. So, you know what? You guys just giving me the spark. Hold me accountable. I got to get it started.
So Instagram, are you on TikTok?
I have a TikTok, but I haven't used it for probably a year.
Because it might be shutting down like this weekend actually, right? So it's kind of crazy, but
yeah, as we speak today, there's 3 days left.
Yeah. We'll see what happens, right? So interesting.
They're trying to have a stay or something. Mm-hmm. But what I didn't realize, I just found out yesterday, is if it is banned, CapCut's going too.
Oh, really?
Because apparently, I didn't know this, CapCut is ByteDance product.
I didn't know that. I love CapCut. I use that for everything. So I'm gonna have to find like a new product and release it. So that sucks.
What do you think is gonna happen with this?
I mean, I literally have no clue. I have no clue. So
you want to take a guess?
I would guess that they'll stop it just because there's enough political power or there's enough lives impacted where it'll get stopped. That would be or it'll be delayed and then eventually stopped. Or that would be my guess. So
my guess is they're gonna pause it and then come up with a solution and it'll be back on again.
Mm-hmm. You just find a way to work around or something. Yeah. So
sell it.
Find a loophole or something.
Yeah. My kids ask me why don't they sell it? Why don't they just sell it to the Shark Tank guy?
Or Elon Musk.
And I said, I don't know. That's a good question, because if ByteDance doesn't sell it to an American, whatever,
they're
losing so much money.
Yeah, probably trillions or billions, right? So it's kind of crazy.
So just take your profit.
Yeah.
It was a great run.
Well, they probably think that they can avoid it. That's why. So that's like the thinking is. Yeah. So that's the thing is they probably have a lot of people connected or in higher up places that they're like, we know we can get this like saved eventually. Mm-hmm. So like that's why it's not worth it for us to take the quick money now or the guaranteed money. So it's like it's a bet, right? It's like guaranteed money today or like potentially like a lot more money like down the line. So
it is. And you know, now that you said that, I think about it, like the Chinese are really good at the long game, right?
Yeah.
Like they're like 5 steps ahead.
Yeah. It's a little scary. Like some of the things like the economy and things that the way that they're in debt, like embedded within like our economy and things, you know. So
it is. I think there's some changes coming.
But this and it's all related to like money, and so that's the thing is like the economy and money. Like I think we owe like the U.S. owes like China a lot of like we borrow money from them for I don't know how this works, but I just know we owe them like trillions of dollars, something billions of dollars, something crazy. But then like it's such a like a interesting like dynamic of like power and life in general is so tied to money, finances, and structuring of debt. You know, and so and that's what you do, right? It's like and then the way that we build wealth, right? Like our company is we take on a lot of debt to build wealth, and like I mean, it's just like debt is such a huge like wealth builder, but it also can like be destructive if it's like not regulated or used correctly.
Sure.
You know, so
sure. I mean, when I was younger, I was like, oh, I don't like regulation. I still kind of don't, but it's necessary.
Yeah.
Like the FDA banning red dye number 3 or whatever recently.
Okay.
It's the latest story. I'm like, great. It was a throwaway crap thing that we were consuming. And if there were no regulations, we'd still be things like that. I agree with that kind of.
Well, I mean, even like if you look at the 2008 crisis, right? It was like there was no regulation. That's why like a lot of people got into trouble. Now, but it's always like a seesaw. Like sometimes there's too little, sometimes there's too much, right? And who's to say what is like the right amount of regulation? So
that's a great point. You're right, because there were no real solid rules back then, and so people were making a lot of money, knowing that it was
Wild West, right?
It was rough. And now it's overregulated. It's overregulated to the point where I don't post anything about interest rates in my Instagram or Facebook thing, because I just don't want to get in trouble. Because we have all these different regulations about if you say a rate, you have to have, there's called trigger terms. You have to have a percentage, you have to have APR, you have to say it doesn't apply to fair housing, So I'm like, you know what?
It's just, I mean, at a certain point, like regulation is like the intent is to keep things safe, but then it slows down business and speed. And so like you're kind of juggling this thing where like the more regulated, and this is even within like your company or team, right? It's like the more safeguards or more regulations you have in your team, the safer the process and things of like the company, but then the slower the business happens. And so you're kind of like always in this balance of like do we want to add more procedures, more policies to our team or company and make sure things are correct? Or do we want to kind of let things happen where we can move faster as a company?
Yeah. Yeah. We've done a great job of maneuvering that, that little quandary right there.
Yeah.
Because no one wants to end up like the DPP.
Oh yeah. Like the current DPP in Hawaii.
Like you can't get anything done. I mean, you know better than I do.
It's very slow.
Yes. So we got to make sure that everything flows smoothly and follows all the guidelines, all the rules, all the laws, and we do that. Piece of cake.
I mean, so like if somebody who's just, I guess they want to buy their first house or they want to like get into some kind of like investment, like or maybe the first investment as a mortgage like broker, what kind of advice would you give them to kind of set them up on the financing side?
So first, I'd want to have a consultation with them. And I've also realized a lot of people don't really care about meeting face to face. Okay. Just phone calls, fine. Videos, fine. Yeah. They just prefer it. Yeah. That's what changed since COVID, right?
Because like that once they experience like the Zoom and the phone calls, they're like, hey, like this is actually more convenient. I can be driving my car or sleeping in my bed and just having the phone call. So
I do FaceTime videos with people sometimes if they have an iPhone, Zoom, or just phone calls. And I'd want to have that consultation with them. Okay. Because I want to know what their goals are. Okay. I want to know what their situation is like and what's their goals.
So every person has like a unique situation and characteristics.
They do. And what most loan officers do is they just say, "Oh, send me your info," and then they crunch the numbers and they qualify for this. But I want to go deeper. Not only do I want to build that relationship, I want to get to know them. I need to know how can I help you and your family. So what are your goals? Like, I don't ask like, what are your goals? But it comes out in a conversation. Yeah, like, let's find out. Is this a starter home? Is this is this a forever home? Yeah. Is this are you gonna live in this for 2 years? You're gonna live in here for 1 year as a primary and then put 5% down. You know
for
what I'm
the next
talking
one,
about,
right? Yeah. For the next one, yeah.
Rent it out. Yeah. Buy another 5% down and rinse and repeat. Or are you gonna raise your family in this home?
Yeah. So that's a big difference in what you're gonna.
Big difference. Yeah. So I think that when clients realize that that's what we're doing, is we're going to ask a lot of questions. We're going to do a lot of listening. They're going to do a lot of the talking so that we can figure out what's the best loan for them. And then during this conversation, we're going to talk about finances too. How much do you make? What's your credit like?
Debt, different things like
who's going to be on the loan, things like that. And so that's the most important thing is to have that initial consultation. And then from there, we map out a plan.
Got it. Makes sense. Well, any last piece of advice for like other maybe up and coming loan officers or people who might be interested in getting into the industry?
If you're going to get into the industry, so it's not that easy to get into the mortgage industry. Okay. Real estate agent, I think is easier. Okay. For mortgages, we have to take a big, I forgot, I think it's 40-hour class.
Oh wow. Okay.
Which is no big deal. I mean.
Yeah. Well, you got to take the class, but.
Right. But then you have to take a test, and you have to get background, fingerprint every year. Or every 2 years. Okay. Every 2 years, I think you do a fingerprint, I think. But we have to, it's pretty stringent. And you can't have felonies. You can't have any, like this, it's pretty strict. Okay. DUIs, things like that.
Really? Yeah, that can disqualify you?
I think you can have a DUI as long as it's not a felony. But it's harder to become a loan officer now than it was before. Just be ready to get your ass kicked initially. Especially if you don't have a mentor or you're not on a team. So I tell new real estate agents this too, because they ask me, what would you do? I said, if I were a real estate agent and if I was brand new, I would join a team. Yeah.
Show you the ropes, right? You got to like figure out how it's done. You got to be around other guys who are doing business.
Right. 1, join a team. 2, have a mentor. It doesn't have to be in that order, but you have to have a mentor and it has to be the right mentor. Someone who's going to show you the ropes, not just tell you. Yeah. They're going to show you, this is how you win. If you don't do this is how you lose. Here's the activities you have to do every day. And they hold you accountable. Yeah. That's what you need. Yeah. And you need it in the lending business too. Otherwise, it's going to be rough going, especially now. So because the market is down and We've lost a lot of loan officers, lost a lot of real estate agents. It's actually the best time.
Yeah, because there's less competition, right? So
if you come in right now and just go all out,
then when the market picks up, you'll be like kind of like set, or you'll be prepared for it. So,
right. And so I tell real estate agents, I have these classes on social media and Google and things like that. I tell them, dude, you implement these strategies right now on social media when the market's down, and you just be consistent. When the market picks back up, you've got a running start. Like everyone else is just kind of starting to stretch, and you're already sprinting.
Yeah. That's very true.
Yeah. So in other words, if you want to join the mortgage industry, go for it. Just make sure you have the right surroundings and the right mentor.
Nice. Yeah.
Yeah.
Well, people want to find out more about you or get connected with you, what's the best place to do that?
The best place to reach out to me is probably Instagram.
Okay.
Not probably. It is definitely the best
Johnny,
place.
is it Johnnyloans?
Johnny_loans.
Okay, at Instagram. Okay.
Instagram. So I didn't want the underscore in there.
You couldn't, but someone took the Johnny Loans already.
And there's somebody that was like a dormant account. Like I was like, man, I can't even get a hold of this guy.
A lot of times the guys are like, just they'll buy a domain or they'll buy like an account and just sit on it, and then they're waiting for somebody to come and then give them money for it or something. So maybe if you reach out to them, he might buy, he sell it to you. So that's like another story for another time.
So now I have to have an underscore and everything now.
But I appreciate you, man.
Oh, thank you.
For coming on.
Thanks for having me, man. Appreciate it.